One of the biggest complaints I've heard from real estate investors is the dreaded capital gains when selling an investment property. In today's video, we're going to discuss more about capital gains taxes and some ways to potentially reduce these taxes from real estate in Canada. But first, let's roll the intro. Hi everyone, Josh here, and before we start, I want to point out that I am not an accountant nor a professional tax expert. I am simply a real estate broker looking to help some fellow real estate investors with their capital gains questions. For professional advice, I recommend speaking to your accountant. With that in mind, let me share with you a bit more about capital gains taxes on real estate. Compared to stock investors, real estate investors often end up with larger capital gains because real estate is such a large investment and the market value is typically worth more than many investors' stock portfolios. When you sell your investment property and the proceeds of the sale exceed the adjusted cost base of the asset, which I'll explain a bit more about later, you realize a capital gain. However, if the proceeds are lower in value than the adjusted cost base, it is a capital loss. Capital losses are not taxable and are only available for non-depreciable assets, such as land, shares, or other investments. On the other hand, when investors sell a capital property for more than what they paid for it, meaning they made a capital gain, the Canada Revenue Agency, CRA, applies a tax on half, 50% of the capital gain amount. So how exactly are capital gains taxed in Canada? Well, to answer that, like I had mentioned before, when a capital asset is sold for more than it was paid for, the CRA applies a tax on half, meaning 50% of the capital gain amount. This means you must pay taxes on 50% of this gain at the marginal tax rate. The tax is dependent on the individual's tax bracket and the province of residence. For example, on a capital gain of $20,000, half of that, or $10,000, would be taxed based on the individual's tax bracket and the province of residence. Now, in order to calculate the capital gains tax you owe, according to the CRA, you need to know the following amounts. 1. The proceeds of the disposition. The proceeds of the disposition are the amount you received after selling off your property. 2. The adjusted cost basis. The adjusted cost basis is the amount you pay to purchase the capital property, including any additional costs incurred during the ownership period for renovations, as well as any costs paid to acquire the property, for example, legal fees. And finally, number 3 includes outlays and expenses incurred to sell the property. These can include legal fees, selling commissions, surveyor's fees, fixing up fees, finder's fees, broker fees, advertising costs, and transfer taxes. Once you've determined that you will in fact have to pay capital gains taxes, there are several ways to potentially reduce your capital gains tax on the sale of your real estate in Canada. Though the inclusion rate of 50% is the same for everyone, there are certain ways to lower the amount of tax on your capital gains. First, you can take advantage of the principal residence exemption. If you currently live in and own one home, with the principal residence exemption, you are exempt from paying capital gain tax when you sell your designated principal residence. Your principal residence does not have to be a place where you live in all the time. It just has to be a place you live at some point during the year. Another method to save some taxes can be timing the sale of your investments and properties. This can be a powerful tax deferral tool. For instance, if your sale has generated you a profit, you might want to consider postponing the sale until after January 1st of the next year. This will in turn incur the capital gains tax that year, and therefore you will only have to pay the applied taxes by April 30th of the following year. If you have a variable income, on the other hand, selling a capital asset during the year when the income is low may save you money. Another strategy to use is giving away assets. If you make a charitable contribution, or if you want to give money to a family member, you can use donations or gifts to reduce your capital gains. You can also use capital losses to offset capital gains. If you have different capital assets where you incurred losses and some where you incurred profits, timing them together will help offset the loss against the profit and reduce your overall capital gains tax. In fact, the CRA allows you to use your capital gain losses to offset your capital gains down to zero. Finally, if you own a small business, a farm, or a fishery property, you can also take advantage of a lifetime capital gain exemption. In Canada, when you make a profit from selling a small business, farm, property, or fishing property, you may be allowed a specific deduction on your capital gain. If this applies to you, you can ask your accountant or visit the CRA website for more information. Hopefully this video was able to answer some of your real estate capital gains questions. If you've made it this far, I want you to comment below what other interesting strategies you've heard of or which strategy you think would work best for you. Don't forget to like, comment, subscribe, and turn on the bell notifications for more content like this, and I'll catch you next time.